one of the very, very popular investment options, which I think all of us have heard, apart from fixed deposit, is an investment in gold. And gold is a very important and a very emotional investment also for most people because they think that it's a little bit of protection from everything around us. So no matter what happens, because gold used to be as a currency thousands of years ago in our civilization, it has had an emotional and cultural association to safety to some extent. So, and gold also is not abundantly available. So it's only limited quantity of gold available on our planet. So it has its own natural special value also because of the scarcity that it has. And most people in the family won't even think of gold in this way, but we already have gold in the family. If you are in the middle class family, you actually have some gold kept in the bank safety deposit or some family heirloom that you have received as an inheritance, a little bit of gold jewelry here and there, which was given to you in your wedding, or maybe somebody gave it to you as a child. Some gold will always be there in the family, but problem is nobody will have a number in their mind as to what is the value of this particular jewelry we have kept in our family. So it's interesting to do the valuation of that, take it to a jeweler and get a value generally, just to know what its value will be based on current gold prices. And so that you know the number in your head that, okay, this is the number of money I have in the assets I have in gold in my household. And then this is how much you have in equity, this is how much you have debt. That will create your picture, that pizza that I showed you earlier, that, okay, this much will be equity, this much will be debt, this much will be real estate, this much is gold. So how do you know how that gold is? Is basically get your own jewelry a little bit valued from somebody, and you generally have an idea as to what the value of that gold will be. But even in gold investments, there is a lot of ways to invest in gold apart from buying the gold biscuit or buying jewelry or buying gold ornaments needlessly. So there is a concept of digital gold also. Does not mean gold iPhones, but digital gold essentially means that buying a gold as a financial asset instead of buying as a physical asset. Because physical asset, you have to also keep it safe. You have to get the headache of keeping it in the bank every time, bringing it out when you require it, again keeping it back. Or if you're keeping it at home, then making sure that it's very secured and nobody knows that it's kept except for you. And it's generally a headache to manage physical gold or physical valuable items that are there kept in the house. Digital gold solves that. You essentially have various options to invest in gold digitally just to satisfy the financial investment part of gold in your life. This will not satisfy. You cannot make jewelry out of digital gold, unfortunately. But this will actually say allow you to save some money in the form of gold in some financial asset. And one way to do that is to buy a exchange traded fund (ETF), which is again trading on the stock market on basis of daily gold price movements that are there. You can buy it as easy as buying shares through your broker. Also, you can do that. Or another very interesting product which has come up again very recently, the past 7 8 years ago, again in the conjunction with RBI, the Reserve Bank of India, and the Government of India, is a product called as a sovereign gold bond. In short form, it's called SGB, the abbreviation of the sovereign gold bond. The idea behind this is very simple. Normally, if you have a digital gold investment that you've made, or even a physical gold investment you made, that does not pay you anything in return. Okay, that is just there. And it goes up and down in value based on the price of gold, and you have to keep measuring it because it's not shown to you by somebody on the screen that, okay, your portfolio of gold is value up and down so much. You have to actually calculate every time. Today's gold price multiplied by whatever you have is the value. Whereas in sovereign gold bond, the idea is that it gives you some money in return on an annual basis. It's a very small percentage, but you get something in return rather than not getting anything in return from owning the gold. And essentially, you're giving money, and the money is kept in gold investment forms. So it also tracks the value of gold or the price of gold over a period of time. So you get the benefit of that. The price of gold movement, if it goes up, you benefit from that. Also, a little bit of return you get by investing in it. And interestingly, it's also tax efficient. It's also tax free to some extent. So understand this item also if you think of considering investment in gold. The only challenge over here is like it is not very, very easy to trade. There is a strict window within which you can buy and sell this particular thing. So be very mindful that whatever you put in the sovereign gold bond is not something you require immediately, or you can withdraw very, very easily. The other gold investments you can liquidate, sell quite easily and quite immediately. You also borrow money against gold if it is in physical form. Some of these things are available. I'm just trying to provide you with different options. That gold is also a very, very interesting investment, not just if you have an emotional attachment towards gold through the family history that you might have, but it's also an interesting financial asset class which is developed quite substantially now, and it's become easier to trade and easier to earn a return over a period of time based on the gold investment that you make. Again, I keep coming back to this thought that when we discussed any of these investments, gold, real estate, financial products like mutual funds, stock, equity and debt mutual funds, or even trading in stocks, or having a fixed deposit, or having a debt mutual fund, everything that you invest in will have its own unique tax implications, and its own tax laws will keep evolving over a period of time. So instead of you not wanting to stay on top of it, maybe your CA can do a job for you. And it's good to have CA as a friend also. Sometimes you can actually talk to them and learn about these things, and hire them, pay them money to manage if they are that kind of a CA who will help you manage your personal account, or find somebody reliable from that network to help you guide about your tax planning also. Again, you cannot plan taxes endlessly. This is not fun to do. This is not supposed to be something. It's a full-time activity. It is just something you strategically think once or twice, periodically update it based on the changes in the laws, and take advantage for your benefit. If something is in your favor, try and make sure that you don't trade something just to change the asset diversification that you saw earlier, that how much in equity, how much in debt, how much in real estate. But you can also manage with your incremental income. The new income that you get can be allocated properly in order to balance things. That's another tax efficient way of doing the investment planning. And for that, you need either a financial advisor or a CA to help you guide through some of these options. So yeah, never forget the tax implications. These knowledge of financial assets might just be one step towards learning that. The next step will be to acquaint yourself a little bit about how the taxes work, or have a professional who helps you understand and execute all these things very easily. One very important implication, which I'll keep coming back to again and again. Again, it's a very boring topic for most people, and that's why they also outsource tax filings to some CA or something, because it's not something people are generally aware and really want to spend a lot of time in worrying about. But you should little bit be aware of this, because we talked about debt and equity, right? And both debt and equity, and also the other investments that you make, whenever you make a profit from uh, selling any of these investments, or these investments pay out certain amount of money to you, the debt will pay you interest, and equity will pay you dividend in the form of giving money back to you. This actually creates a gain or an income for you. And in the eyes of the income tax authorities, this gain is supposed to be taxed. And these tax rules have modified, or they keep changing over a period of time. Don't worry about that. Your CA will definitely help you understand all those things. But they are real. And because these assets are now financial, you cannot just not pay taxes. You have to pay taxes on all the gains that you make when you file your returns every year. So both of these instruments will have different taxation. So understand that from your CA, or acquaint yourself. This literature is really available in various simplified format. The tax on equity is a little lower. Tax on debt until last year was also lower, but it has changed in different formats. It has changed, so that's why I don't want to go into the complicated discussion on tax. But be very aware. Don't ever forget that there's a different tax, and based on that, you also determine how you buy and sell. So if you don't want to incur that tax, don't sell that thing. Maybe invest your new income that you've received into different asset classes to rebalance the percentage of debt or percentage of equity that you have. So there are different strategies we can plan over here also. And this is something where taxation also is an important consideration when we are doing investing. So we cannot not think about tax before investing.